Hello, welcome back. We're here to start actually the first part of our program focused on steel markets. With me today, I will have very interesting speakers. First, I would like to start with a brief introduction, if you allow me. I've prepared just a few slides. It's just a way to set the scene about where we are in the steel market at the moment, so that we can then, with our guests, discuss how we got here and where we will move from here. Let's start. I really put together only a few slides that you probably all know very well, but I think they're always interesting to look at. Let's start with the iron ore. I called it iron ore roller coaster. You all know what happened since beginning of 2020. In a way, the jump in prices of iron ore was unprecedented and also unexpected in this magnitude. We went to go beyond $200 per ton for iron ore in China. Since then, during the last few months, we saw a big collapse in a way of prices because of course, a change in sentiment in the Chinese market. But again, in the last 3 weeks, the market picked up again, jumped up again, confirming that the volatility is really strongly there. But what is interesting for me is understanding what changed in a way. Usually a few years back, the iron ore prices would have driven the entire sentiment of the steel market from other raw materials to finished steel. But this time around, we got the confirmation that it's not like this anymore. It's not happening anymore. So let's look, for example, of what happened at the scrap market. This is the benchmark for Turkish scrap CFR. Again, the movement was similar from the first part of 2020. Scrap prices picked up rapidly, reaching a new record beyond $500. Then again, a correction, so in line with what happened with iron ore. But then look at the end of the graph. This morning, my colleagues from Turkey were texting me that the price of $500 has been reached and surpassed again in new deals. So we're back at the record levels. The price has jumped up again, and in a way it has moved a lot differently from what iron ore has moved. Look at this graph that I prepared. So on the top line, you see on a percentage scale what happened from May 2021, which was the peak of the market this year, until the 25th of September. Iron ore lost around 50% of its value in this period of time. In the same period of time, scrap only lost around 10% of this value. Similarly, from the 20th of September until today, the recovery was, of course, much stronger in iron ore, around 20%, whereas the scrap recovered around 10%, so went back to its level. So what you can see, especially in the graph above, is that the movements have been very different, and this confirms that a new sort of pricing scenario seems to have taken the lead and the leading role in a way in the steel market. I'll just show you this graph and then I conclude and we can move with our guests. But we all know what happened, but just have a think about this. Back in first part of 2020, when iron ore price was at around $100, Chinese hot rolled coil prices were around $500. They might be moving between 500 and 600, but that was the normal for many years. In the new normal, we have iron ore prices jumping to new record level, hot rolled coil prices jumping to new record level in China as well. But then when iron ore prices fall back to $100, hot rolled coil prices in China did not fall back again. And the reality is we have new elements supporting steel prices at the moment. We will talk about it: energy prices, CO2 emission prices, so ETS in Europe or other elements in other parts, investments needed to cut CO2 emissions, other raw material prices. So we are definitely in a new normal that we need to look into it. So well, thank you for this. I would like now to invite the first speaker of our session, actually, Paul Polman, if he's with us. Well, we can't create the connection with him at the moment, so maybe we move on to the chat with Russell Codling. Yes, I can see Russell is there. Let's see if James can reach us as well. I will start introducing them so that we can get to know them. So Russell, hello, can you hear me?
Afternoon, I can hear you. Can you hear me okay?
Good, very well, very well. So Russell, as you know, is a member of the Tata Steel Europe team. He's Director Marketing and Business Development, and he will be joining us for this conversation. We're waiting for James from CRU to join in. I'm sure it's a matter of seconds, but we can start very quickly. Oh, James is here. I just see his face appearing. Can you hear us, James?
Hi. Yes, I can. Thanks.
You see, technology is incredible, right? So thank you for joining. As I said, James is the principal analyst for steel at CRU. We had a few chats together during the last weeks to organize a little bit what we were talking about. We have a little bit of time, so we will be talking about the situation, and I know they both share very interesting views. Also, I want to remember for all of those online, you can ask questions online, and we are gathering them, and then we can try and look into it later. So I want to start with James, if you are okay with that. So the event is titled "Let's Talk About the Future," which, by the way, is a very interesting title that I really enjoyed. But first, I want to have a step back with you. So how did we get where we are? I mean, what is your opinion, the main driver of the price and demand rally that we noticed during 2021 so far?
So what we've seen over the last sort of 12 to 18 months really is a supply deficit situation in Europe. And of course, that's affected the US as well. And it's all been down to the pace of the COVID recovery. The demand recovery was really quicker than people expected, and supply was slower to respond. And that meant that simply people couldn't get steel fast enough. So what we had was a scramble to secure resources, and part of this was because of that, lead times extended. So people started ordering a lot more at the back end of 2020, but it's really taken 6 months or so for that supply to really get to the market. So we've had a period in the first half of 2021 where people couldn't get enough supply, and that all started in China. And the Chinese economic stimulus is a lot more commodities intensive than anyone expected. And that meant that when Europe was starting to kick off in terms of demand this time last year, some of that supply was feeding China. So international markets were seeing a pull from China, and that meant the rest of the world was short. And that's fed through really up until the present day, where it's taken a long time for international markets to rebalance in terms of supply.
So you think we are still living in a sort of backlog from this demand rebound that has taken us unprepared in a way?
Yeah, everybody was unprepared at the speed of the recovery. And I think what we're starting to see now is the steel that people have ordered is now starting to arrive. We saw that at the start, just before the summer, and it's now really starting to appear in the European market.
So Russell, sorry.
Taking a long time, but finally that supply is coming.
So Russell, what James is painting in a way, the picture that he's painting, and also I tried with my graphs to show how the sort of pricing panorama has changed completely, is pointing to high steel prices. We all know steelmakers across the world will have great financial years in 2021, which is, of course, a good thing, given that Tata Steel is hosting us today. But the question is really how a large group like Tata Steel, because these high prices have a benefit, but also can weigh on the whole supply chain, including your clients. So how is a large group sort of preparing and working with the clients to make sure that the whole supply chain can be ready for this new normal, let's call it, in which steel will be more expensive?
Yeah, I mean, I know it's been a very challenging time for all of us. And when you look at the sort of supply and demand balance picture that James has just painted, you look at the middle of last year when we were scrabbling around to find any demand for steel across the globe, and then the early part of this year when demand was supply was very tight, and we were finding many of our customers desperate for material. And it's been a really, really challenging time for them, I know, trying to deal with availability of material, as well as those price increases that you're just describing there. I think we've tried to make sure that we're supplying against the commitments that we have, and also to make sure that our long-running customer base is being supported where they needed it. And where they needed material to get their own plant back up and running, to meet the grossly increasing demand across the globe. I know it's been very difficult to plan, and we've been doing a huge amount of work to try to plan and make sure that we're supplying our customers in the right way. It's been a really important feature for us and a really important challenge for us to address. But I guess when we look at the sort of stronger price levels that we've got at the moment, it's all relative, really, because I think it's easy for us to forget the losses or the very depressed price levels that we've seen over the last few years, over the last decade or so, certainly since the global financial crisis. And I think when you look at the level of margins that sort of existed across the steel industry, those have not been in a sustainable state. Where we need to continue to drive our own investment. And we're starting to do so. We need to get that investment underway to meet the needs of our customer base. And I think later on today, we're launching one of our new investments in a new caster, which is absolutely critical for us to be able to supply the advanced high-strength steels, the ultra-high-strength steels that our customers certainly need into the future. And that's before we start to look at the decarbonisation challenges we've got ahead of us. Decarbonisation, I guess, is one of those sort of big challenges of our lives, of our era, and something that we need to step up to pretty substantively. So when you look at the huge amount of investments required, the billions of euros of investment that's required to put into our facilities, to convert them, to achieve the decarbonisation challenges we're looking to achieve in the future, I think a stronger market price, a stronger price base is absolutely critical for companies like ours and for society at large, so that we can deliver on our own commitments. And I guess perhaps just sort of taking that even a little bit further, Emanuele, one of the things that we've been really keen on making sure that we're doing this year is keeping that as transparent for our customers, like we want to do so in terms of availability, but we also want to make sure that the investments that we're putting back into our steelworks, the investments and the challenges or the costs that we're incurring around things like the emissions trading scheme, the scheme that the European Union's put in, which is really important, I think, and I guess we support that because it's required for governments to step up in regulations in these challenging times, so that we've got the monies being channeled into the right spaces to support these decarbonisation challenges. And increasingly, we've seen the carbon price this year start to rise. It's up to what, 60-something euro per tonne now, Emanuele, yeah. And that's certainly a challenge for us and I know a lot of our customers. So we need to make sure that's visible and transparent for everyone. So what we've done is we've put in place what we've described as a bit of a carbon surcharge, so that it makes it a bit more transparent to everyone what those costs are that we're incurring, that we're then passing on to effectively back into the emissions trading scheme, which helps support decarbonisation projects of lower cost to abate solutions for other industries. And ultimately, I think that will probably come around to our customers, to ourselves, to that government will be able to help companies like ours and our customers.
And how is it being? How is it been going so far with this new surcharge, for example, with the conversation with your clients on the fact that, as you put it nicely, I was speaking with one of your colleagues and competitors from another company. They said the same. They say, yes, price will be more expensive, but there's no way out. I mean, green steel will be more expensive, but people need to realize that, and there's no other way. How's the response from your clients as of today with in terms of accepting the surcharge and understanding that we are in a new normal where, of course, prices of steel will be a little bit more expensive, but on the other hand, the service provided also toward decarbonization by large groups like Tata Steel are vital and are central to our society?
Well, I think there's no one likes a surcharge. No one likes higher prices ultimately. But I think we're all in this together. Everyone recognises the global challenge. We've got COP26 coming up in 2 or 3 weeks' time, and I think one of the things we're expecting to be seeing out of COP26 and certainly the G20 program in the next few months as well is broader governmental commitment around taking action. I think the latest strap line is keeping 1.5 alive, and that's going to translate into increasing cost of carbon. It's going to translate into commitments on everyone's balance sheet around the level of emissions that everyone's incurring right across the value chain. And I think it's something that's really important for everyone, and I think our customers are recognizing that certainly too. That transparency is critical if we're going to make a difference. I guess we're in one of the beneficial positions because at the moment, as an integrated steel producer, we've got one of the lowest levels of carbon intensity for any steel maker across the globe. So that puts us in a good position to start off with. But that's only because I guess we've spent many years focused on this issue. On efficiencies and making sure that we're reducing our emissions, but we've got a long way to go. There's no two ways about it, and I think that transparency will be required. It will be required for border adjustment mechanisms if our governments put those features in place, and it will be required for all of us to be clear on our own value chain emissions, things like Scope 3 emissions. So I think it's a first step on that journey, and we've got to work both ends of this stick. We certainly need to be investing in our own decarbonisation. We need to be offering out reduced carbon emissions in relation to the products we're producing. So those so-called green steels, we will be doing that, but also I think we need to start that journey with some transparency around what's involved in the supply chain as it stands today, and that I think has been well received across our customers.
Yes, and James, Russell mentioned many things that are very interesting. I think he also just mentioned the carbon border adjustment, for example, which might be put in place. I mean, we talk about possibility, but we know that it's really on the table. It's close to be finalized in a way. My question is, I mean, we come out of a few years' time where trade restriction has sort of taken the central stage of discussion around the steel markets, being it with the US or Europe or China and so forth. We start to move in a new normal, as we said, with higher prices, but also in a situation in which trade restrictions seem to be taken over in a way by the environment, by investment for lowering CO2 emission, but also potentially borders to stop higher CO2 emissions still being traded. So if we look at 2022, 2023, what do you think will be the main driver, the main point to look at? Do you think both will continue to remain important, or there will be a shift?
I think both are going to continue to remain important, but I think it's going to change. And the two, of course, are linked. I think if we look at trade, one of the interesting things we've seen around the trade restrictions, it's been driven by anti-dumping duties in recent years. And that's subtly changing now. We're starting to see more of a wave of taxing at source for exports. So Russia put in a temporary export tax. There's talk of a more permanent taxation for Russian exports, and that would increase prices around the world. We've also got the Indian government talking about potentially putting a tax on exports as well, and they're two of the biggest exporters of sheep products in the world. We've also got the Chinese government looking at, they've removed tax rebates for exports. So exports are now more expensive. They're higher cost essentially for Chinese producers, and that's to disincentivize exports. And this is where it links to decarbonisation, because China's at a different part of the journey of decarbonisation. It's looking to reduce emissions, and part of that is by reducing output, and Chinese output targets are to be lower than we've seen in 2020, and the peak was in half 121. So we're going to see exports fall from China next year compared to the peak we saw in the first half of this year. There's no doubt about that. We've also got demand growing in Asia as well. So there's new capacity coming on stream in Asia. But we've also got, we've had a weak second half of the year, and a weaker than expected 2021 in Asian countries, especially Southeast Asia, because they've had additional waves of COVID, unfortunately. And unlike Europe, there's not such a high degree of vaccination. So when we look to 2022 and 2023, then that lost demand will come back, and there'll be more call on local production in Asia for those Asian countries, especially if China is less active. If we look at the cost of decarbonisation, then Russell was talking about the things are going to be more expensive in the future. And I think the carbon surcharge really is the very start of that we've seen in Europe. And there's no doubt that decarbonisation has got to be paid for somehow. And it's either through higher steel prices, or it's through general taxation. It's got to come from somewhere. And if we look at one of the other things Russell said was around the profitability of Europe, then European steel industry has broadly for the last decade been break even by our analysis, and that's not a sustainable level. So this year we've seen prices detach from cost by a record extent, and they're going to fall back in line in the medium term, but they will fall back in line to a different level, I think. And we need to see more sustainable margins in Europe to pay for decarbonisation, and that cost of decarbonisation itself will have more and more of an impact over time. Now, our view is that if we look at the impact of CBAM in Europe, then that really starts to pick up in 5 years' time. But that's with policy as it stands today. And Russell was talking about how policy is, being influenced and adapted very quickly. And it's more than likely that we haven't seen the end of these policy changes, that we're going to see CBAM or whatever new policies come into play accelerate. If anything, the last year has told us that we're going to see an acceleration of these decarbonisation trends, and that path is going to be bumpy.
No, absolutely. And you mentioned also, if I can come back on the trade topic, where you mentioned a lot of trade restrictions. As we mentioned last week in Italy at the Made in Steel conference, one of the biggest talk was about actually steelmakers pushing and lobbying the European Commission to restrict scrap exports from Europe, for example. They are very keen in putting out the message that scrap is our biggest raw material and supply of raw material, but also is central in the decarbonization process, with some integrated mills, of course, moving into using EAFs. And they believe the move is to limit, not stop, of course, but limit in a way exports of scrap. So that's of course very interesting, and it links. I have a view that that these two topics will sort of merge together. No, the trade restriction and environmental changes will merge together, and maybe, and this is only me talking, but maybe the CBAM, for example, will step by step maybe take over from the safeguard measures right now and so forward. But then I have a direct question, because I know we have in the audience also someone from the United States, but also online. But you mentioned all these limits, these export limits. But does it mean then that we might be moving toward a steel market where we don't need import limits anymore? I'm thinking about Section 232 or safeguard measures. I mean, if the trade and the availability is just not there, why do we need barriers? James.
Yeah, it's a good question, and I think we're going to see some changes to 232. I think that's a developing situation at the moment. I think the new administration in the US is probably going to start to drive to a relaxation of 232. Certainly, if there was a deal struck between Europe and the US. So I think it's about partners working together there. The other thing that's interesting for the US market, of course, is that the US is a very decarbonized industry. It's already moved to a high degree of EAF steelmaking already. So, what you say about, could we see Section 232 be replaced by decarbonisation taxes or tariffs? Then the US actually, by almost, I suppose, by luck over time, has ended up with a decarbonised industry. And you could see very quickly, those 232 taxes being replaced by a carbon surcharge in the US as a protection for the US market.
Yes.
And if you look at sort of, that's going to be a big benefit for US producers. In fact, if you look at green steel more broadly, then there's a large amount of capacity coming on stream, which is EAF based, in the next year or two in the US. If you want green steel in the first instance, you could see the US being a bigger competitor than, say, the traditional sources of Russia or India or what have you.
Of course,
going forward in the first wave.
Yes, thank you. Russell, let's move also. I would like to pick your brain also on the topic of end users in the end, demand. I mean, we started by saying that we got here because there was a shortage of supply. You both sort of hinted to the fact that maybe this backlog have been resolved in a way, and we're getting into a more normal supply-demand situation. But I was very we all know that during the last few months, the automotive sector, there has been a lot of information regarding, of course, lack of microchips for the automotive sector, stoppages at car makers. So considering the automotive sector uses around 15-20% of the steel in Europe. What's your view actually for the sector for 2022? Should we be concerned in terms of demand from that sector, or you think is something being resolved?
This is another interesting area, isn't it? We're talking about trade, we're talking about decarbonisation and sustainability, we're talking about sort of global politics, and I think we're kind of ticking down a number of boxes on some of the big mega trends that exist. We haven't quite got to digitization or anything yet, but this one's around the topic of globalization and localization. And my goodness, if it's been a bumpy ride for the steel industry in the last few years, anyone that's had to live through the turbulence of the automotive sector. I mean, obviously we're right in the middle of it, but your heart's got to go out to all of those companies that are trying to invest and make something of what's a very challenging industry. I mean, they had to suffer the closure of plants as suddenly no production could continue through COVID. People stopped buying cars, they stopped traveling, there was all the lockdown. And that had huge levels of disruption to the automotive supply chain. And then I guess we were also then constrained from being able to travel, and that led us to building up perhaps a backlog or a level of savings that people could actually go and spend. And perhaps as you came out the other side of COVID, people might have been ready to replace their vehicle. But my goodness, and then suddenly we get the next disruption in the supply chain for the automotive sector. And when you look at what that's translated into, you look at any chart and see the deterioration in vehicle registrations across Europe, and we had a dramatic reduction through the course of last year. But we're in another one of those big troughs at the moment. Just looking at the recent automotive registration data from the European Automotive Association, ACEA, last week. We're in another 25% reduction year on year. It's just an astounding situation, and that's certainly playing through into steel demand at the moment. And when you look at the reasons and what I guess our outlook is into the coming year, and who's an expert in this space, I guess very few people are at the moment, but we're certainly looking out to the semiconductor industry and try to understand what the driving factors are there. Whether it be some of the trade wars we saw in recent years with the sort of 5G challenges, the availability of semiconductor production for the world, the increased sudden demand from, as I was describing, from consumers as they weren't buying a holiday or other services. They had the ability to buy new kit, new equipment, and more often than not that required semiconductors. And there's those kind of semiconductors are perhaps the most advanced ones, the ones which I guess as we would describe as being differentiated products that you want to be focusing your business into, not perhaps the legacy products. And that's the situation, I think, in the semiconductor industry, the result of which there is the availability as demand has really started to peak. And the lack of availability of free capacity in that sector, because I guess like the steel industry and semiconductors, it's big capital investments, big equipment. You've got to operate it as efficiently and as high levels of utilization as possible, and the ability to suddenly ramp up output is pretty tight. So they're going through some pretty tight challenges there. And I think the best outlook that we currently have got, when we look at all the different players involved, is that at some point over the course of next year, perhaps towards the back end of next year, we could start to see some positivity.
Okay.
But I think from the steel industry point of view, we've got some concerns. I mean, if I was running an automotive company, I would be looking at how I could be ramping up production as soon as I had the supply chains in place. And I think there's certainly pent-up demand from the consumer. You can see that in the second-hand car prices at the moment. They're almost exceeding the brand new car prices. So that's clearly there. And as soon as the supply chain constraints have been addressed, I think we'll see some big peaks in vehicle production, vehicle output, vehicle registrations. Customers will be wanting to get their electric vehicles so that they can start the decarbonisation path themselves. So I think we've got a pretty rocky road ahead, but I can't quite see it likely to be until the second half of next year at best.
Okay, perfect. So some clouds, but not too concerning at the moment, for at least. But James, another issue continues to be, and it's increasing in these days, is energy prices, which goes both ways, because on one hand it's impacting steelmakers clearly, and all industrial players. On the other way, it could even impact consumers in a way. It could impact a little bit, it could feed in the possibilities of consumers to actually consume goods. So how do you see this unfolding also going into next year?
So, I mean, when we started talking about this meeting a few weeks ago, the energy crisis had just started, and we were questioning whether it would still be around. And three or 4 weeks later, it's the top news story, and it's not going anywhere over the winter. In Europe, we've got EAF producers that are more exposed than blast furnace-based producers, integrated producers. So that's affecting the longs market more than the sheet market at the moment. But there are differences by country as well. The UK and Italy have a higher percentage of gas usage for electricity, and they're more exposed as countries compared to Germany, for instance. Turkey is also very, very exposed for gas. So there are differences by country as well as by the type of steelmaking technology. And that's going to be important through the winter. At the moment, there's two questions. One is about absolute energy cost, and one is about security of supply. And I think it's the price that's more of a problem than security of supply at the moment. So that's definitely going to have an impact by creating a higher cost floor for steelmakers over the winter. And that's also going to be a challenge because, like you say, we could see demand being hit over the winter. Not just because consumers may have less disposable income, but we also might see, industrial demand or be pushed to a lower level because of those high costs further down the supply chain. And that's the sort of thing that we've seen in China as the maybe an example of what's happening already there. We've seen supply cut quite significantly in China, but we've also seen demand being hit. So how that balances out over the winter is quite uncertain. And I think that's really the thing to watch over the winter.
Yes, absolutely. What is interesting, though, is that you mentioned China, but the unexpected seems to be the rule now in the market. I mean, I remember also when we talked a few weeks ago, we had we were all expecting the Chinese construction market to be collapsing, maybe because of the Evergrande story and so forth. Then suddenly, from one day to the other, power cuts became the biggest story in China, and the sentiment changed again. So I also wanna enter in this sort of topic of the unexpected, because the seminar, let's say this event this afternoon, it's called "Let's Talk About the Future." I always describe 2021 as the year of the unexpected. How would you expect to describe 2022 in 2 words? I mean, what will be maybe an unexpected driver or an unexpected or something to look at that maybe we're not focusing our attention enough? Russell, if you want to start.
It's quite an amusing question, really, isn't it? What do we expect to be the unexpected? I mean, I guess we're talking about the new normal and all these sort of terms at the moment. I just don't think it exists anymore. The only piece I can suggest that we should be expecting to see in the coming year is a continuation of this erratic behavior. I think it will be some time yet before, so many years yet before we come to a stabilization after COVID. We've talked about stagflation at the moment, where we're talking about very high levels of inflation. We're likely to be seeing increases in interest rates that might well suppress the availability of cash, but it will also drive investment. So I think we should be belting up and expecting to be on a pretty rocky road over the coming years. We need to be expecting the unexpected. We might be looking at this point in time and saying, well, look, these very high unprecedented price levels, it could be worse. I think there's plenty of reasons why you could describe that the supply-demand imbalance increases even further. We've got a lot of incentives from government, from new policy, from decarbonisation, which are driving and could well drive demand. I've just described some of the spiking potentially in pent-up demand for automotive. So I could quite easily describe a very positive demand outlook for steel. Mm-hmm. And I think if that demand plays out and supply remains constrained, then you could see another spike. I don't think that's necessarily an expected point, but equally you could play many other different scenarios out for the future. But I think the unexpected, perhaps unexpected for a few years ago, the unexpected now is that things are going to get very lumpy, very erratic.
James, what's your view? And may I add, Russell, that as you said, it can go in both ways, because we also didn't mention yet the next generation EU plan for investment, which might really push the sentiment strongly. James, what's your view for the next few years?
I think I agree with Russell that we've got sort of volatility is here to stay. The route to decarbonisation is not going to be straightforward. It's not going to be easy. We've also got an economic recovery happening at the same time, so that when the two are playing against each other or for each other, we could see swings, either way. I think there's, if we look at 2022, then we've got a stock cycle in Europe, so we've got an apparent demand and a real demand stock cycle, difference that we're going to see some changes there. So stocks we're going to see that restocking turn to destocking. That's sort of the expected, I guess.
Mm-hmm.
I think within the energy crisis, if we see the energy crisis hit consumer durables, and Russell talked about the consumer durables boom, the energy crisis could see that consumer durables boom stop dead. And if that happens, actually it could free up the supply of semiconductors for the automotive industry and actually feed into that automotive output boom maybe in the second half of the year. So we could see a weaker first half, stronger second half. I think the real uncertainty that could really change things next year is Chinese policy. If anything, has been a sort of the biggest lesson over the last few years. It's been what you can expect is an unexpected new Chinese policy, one that you haven't thought of, but it will impact the steel market. And the one that stands out to me is, what if China implements its own carbon tax like CBAM, and it doesn't do it so that the full impact is coming in 2025 to 2030, but the full impact comes next year? That's the sort of change that we could see as China accelerates its decarbonisation agenda.
Absolutely, very interesting. Well, first of all, I want to thank you both for being with us. I think it was very interesting. I know that, so thank you very much, and we'll see you very soon. We should have with us very soon, in just about a minute, Paul Polman to give his presentation. While we wait for him to get connected, I want to just wrap up a little bit what we said, and what James said at the end. I think it's very interesting. I mean, the unexpected factor might be coming from China as usual, and the unexpected factor could be that we've been looking, as Europeans, we always look at us as the center of the world in a way, or we look at our strategies as very central, but maybe China can actually be quicker than us for example, on the carbon border adjustment or on the push on decarbonization, and this could definitely be a change, an accelerator for us.